3 steps to calculating the 3-to-1 rule in trading. The 3-to-1 rule is a principle that says traders should only enter trades where the potential reward is at least 3 times greater than the risk. This rule ensures that over a series of trades, a trader can remain profitable even if only half of their trades succeed. For new traders, the stock market can be intimidating. Emotions like fear and greed can lead to impulsive decisions. The 3-to-1 rule provides structure and helps beginners maintain discipline. Here's why it's particularly important. First, it encourages controlled risk-taking. Beginners often enter trades without a clear plan, risking too much capital. By calculating risk and reward beforehand, traders avoid oversized losses. Second, it helps set realistic profit targets. Many beginners either sell too early out of fear or hold too long hoping for unrealistic gains. The 3-to-1 rule provides a clear target that balances opportunity with caution. Third, it improves long-term profitability. Even if only half of the trades are successful, maintaining a 3-to-1 risk-to-reward ratio ensures the overall trading account grows steadily. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use the code BLOG to receive 25% off your next purchase. To implement the 3-to-1 rule, you must first understand how to calculate risk and reward in trading. This ratio isn't arbitrary. It's grounded in probability and risk management. Trading is never about winning every single trade. It's about making sure your wins outweigh your losses over time. By sticking to the 3-to-1 rule, beginners can trade more confidently and reduce emotional decisions. Step 1. Determine risk. Risk is defined by your stop loss, which is the price at which you'll exit a trade to prevent further losses. For example, if you buy Apple at $250 and set a stop loss at $245, your risk is $5 per share. Step 2. Determine reward. Reward is your target price where you plan to sell and take profit. Using the same Apple trade, if your target price is $265, your reward is $15 per share. Step 3. Calculate the risk-to-reward ratio. Divide your reward by your risk. $15 divided by $5 equals 3. This is a perfect example of a 3-to-1 risk-to-reward ratio. By following these steps before entering a trade, beginners can filter out trades that don't meet their profit expectations, which helps focus only on high-potential setups. The 3-to-1 rule doesn't just rely on numbers, it requires strategic planning of entry and exit points. Beginners should focus on technical analysis to identify these levels. For Apple stock, look at recent price trends, moving averages, and support, resistance levels. For example, if Apple has repeatedly bounced off $245, this becomes a potential entry point. Your exit target should align with resistance levels or projected price patterns that give you at least 3 times the potential risk. Remember, the stop loss should never be arbitrary. It must reflect a level where your trade idea is invalidated. This ensures that even if the trade fails, your losses remain limited. The 3-to-1 rule is flexible and should evolve with market conditions. Traders can use trailing stop losses to protect profits while allowing winners to run. For instance, if Apple moves in your favor, you can move the stop loss closer to the current price, locking in gains and maintaining a favorable risk-to-reward ratio. It's also essential to adjust position sizes based on the amount you're willing to risk. A general rule is to risk no more than 1% to 2% of your total trading capital on a single trade. This protects your account from major losses and keeps your trading consistent. Technical analysis tools enhance the effectiveness of the 3-to-1 rule. Indicators like moving averages, Fibonacci retracements, trend lines, and RSI help identify strong entry points and realistic reward targets. For example, if Apple is trending upwards and bouncing off a key moving average, setting a 3-to-1 ratio target aligned with the next resistance level increases the likelihood of hitting your reward while controlling risk. By combining the 3-to-1 rule with technical analysis, beginners can make data-driven decisions rather than guessing, which is essential for sustainable trading. Now that you understand the 3-to-1 rule and how to calculate risk and reward, let's discuss how to implement it in real trading scenarios using Apple stock as an example. Suppose Apple is trading at $250, and after analysis, you identify a strong support level at $245. You set your stop loss slightly below this at $244 to limit risk. You then identify a potential resistance level at $259, giving you a reward of $15 per share. Your risk is $6 per share, so your risk-to-reward ratio is $15 divided by $6 approximately equals 2.5 to 1. While this is close to the 3-to-1 rule, it's slightly below, so you might choose to wait for a better setup where your potential reward is higher relative to your risk. By being selective and only entering trades with at least a 3-to-1 ratio, you increase the chances of long-term profitability. It's better to take fewer, higher quality trades than many low-quality trades with poor risk-to-reward ratios. Conclusion: the 3-to-1 rule in trading is a powerful and beginner-friendly strategy that focuses on risk management, realistic profit targets, and disciplined trading. By ensuring that potential rewards are at least 3 times the risk, traders can maintain profitability even with a moderate success rate. Implementing this strategy requires careful calculation of risk and reward, strategic entry and exit planning, and the ability to manage trades effectively. By combining the 3-to-1 rule with technical analysis and strong psychological discipline, beginners can confidently trade stocks like Apple while minimizing losses and maximizing gains. Thank you for watching.